Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Rigetti Computing.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, let's start at the very beginning here. We're talking about a company in a field that feels, almost like science fiction to a lot of people.
It does. And you have to frame it correctly. Rigetti is, they're an early stage firm. Very early.
Meaning pre-commercial, right?
Exactly. They are firmly in the pre-commercial phase of the quantum computing industry. So their current revenue is modest.
Modest feels like a polite word.
It is, but it's multifaceted. It comes from a few different streams.
Okay.
You've got subscriptions to their quantum cloud services, which they call QCS.
Right.
Then there's some direct hardware sales, and really importantly, collaborative research partnerships.
A lot of that is government funded, I assume.
Yes, that's often the case. It helps fuel the R&D while the commercial side ramps up.
So when we say modest revenue, we're saying the cash flow today doesn't really justify the valuation. The market isn't looking at today at all.
Not at all. It's looking forward. It's focused on a very, very specific technological goal.
And that's what we need to hone in on.
Precisely. The whole story, the whole valuation, it hinges on their tech roadmap.
Which has one critical target.
One single target, achieving functional 100-plus qubit systems by the end of 2025.
And this isn't just about a bigger chip. This is seen as the real inflection point.
It is the inflection point.
So why 100 qubits? What is the magic number there? What can you do at 100 that you just can't do at, say, 50?
It's the difference between a prototype and an actual commercial tool.
Okay.
At lower qubit counts, these machines are mostly for academic research, maybe some niche problems.
A science project, basically.
Essentially, yeah.
Okay.
But once you can reliably hit that 100-plus qubit threshold, you start to unlock real commercial utility.
In what kinds of areas?
Things like high-fidelity molecular modeling for drug discovery, advanced logistics, complex financial modeling. It stops being a science project and becomes an enterprise solution.
That makes the timing absolutely critical then. The market must be watching the calendar very closely.
They've already set their clocks. The next major check-in point isn't that far off.
When are we talking?
We're talking about the Q3 2025 earnings report. The market expects that in early March of 2026.
And that's when the rubber meets the road.
That's it. Not just for confirming they hit the qubit target, but, and this is key, for seeing the first signs of real commercial traction with those QCS subscriptions.
Which brings us to the financial underpinning of this whole thing. For a company that is basically one big high-stakes R&D project, cash is king.
Liquidity is everything.
Yeah.
Rigetti's financial position is incredibly robust.
They're sitting on a lot of cash.
Approximately $600 million in cash and investments.
$600 million. That is a massive war chest. It gives them a runway for years, doesn't it?
It does. It's a huge competitive cushion. Think about it. Some of their rivals might need to keep raising capital, keep diluting shareholders.
But Rigetti has bought itself time.
A lot of time.
Yeah.
And that cash burn, their free cash flow is negative, of course.
Right.
But that money is being aggressively reinvested, not into buybacks or dividends. It's going into proprietary IP, patents, and building out their ecosystem partnerships.
It's an all-in bet on the future.
Exactly.
So if they're spending all this money, they have to be building a fortress, a competitive moat. What does that moat actually look like for Rigetti?
Their core advantage is what we call full stack integration.
Meaning they do everything themselves.
Pretty much. They don't just make a chip. They control the entire stack.
So that's the superconducting quantum processors?
Their own proprietary software and the delivery system, the hybrid quantum classical systems on their cloud service.
And when you build on a system like that, you get locked in. That sounds like high switching costs for any developer who commits to their platform.
It absolutely is. That's a classic way to build customer stickiness with the new technology.
So how does this differ from their competitors? Let's talk about IonQ for a second.
Good question. Because the choice of physics really matters here. IonQ uses a different method called trapped ion technology.
Okay.
Rigetti, with its superconducting approach, is really focused on one thing: faster scalability.
Hold on. If the physics is fundamentally different, superconducting gates versus trapped ions, How can we as investors even compare the technical risks of those two?
That's a brilliant question, and it really gets to the core risk of the industry.
Right.
Rigetti superconducting systems are incredibly fast, but they need to be kept near absolute zero.
So huge engineering challenges, huge costs.
Exactly. Trapped ion systems, on the other hand, run warmer, but they need unbelievable laser precision to control the ions.
So Rigetti chose the path that they believe scales faster, and they're betting they can solve the engineering problems along the way.
They're betting they can solve the engineering. And their path is tied directly into the biggest trend in tech right now.
Artificial intelligence.
That's their second major differentiator. They are pushing hard on hybrid AI quantum solutions.
And what does that mean in practice?
It means building in specific compatibility. Notably, they have NVIDIA NVLink compatibility.
So their quantum processor can talk directly to NVIDIA's AI hardware.
Seamlessly. It's a strategic bridge between their quantum world and the massive existing AI infrastructure. That's key for getting early commercial wins.
Okay, let's pivot to the market. Let's talk about the stock itself. There's been some recent volatility.
There has. The stock recently slid about 8%.
Down to what, 22.55?
Down to $22.55, yeah. And that happened during thin holiday trading.
So to a casual observer, that just looks like a sell-off.
It does. But most analysts are reading it as more of a healthy cool down.
A cool down from what?
From a pretty speculative rally in the quantum space that happened around December 22nd. So this dip could actually be constructive.
Forming higher lows on the chart, maybe?
Potentially, yes.
Yeah.
Which is a bullish technical pattern.
So if the stock is cooling off, where are the technical analysts looking for entry points?
Well, based on that recent action, buyers are watching the, say, 22.55 to 22.57 range as a possible floor.
And the upside targets.
They are quite wide. They reflect the binary nature of this kind of investment. They range from $30 all the way up to $50.
Wow, a $50 target is huge, especially given the execution risk you just laid out. Are analysts really factoring that in, or is that just pure speculation?
It's a bit of both, honestly.
Oh.
The $30 level seems achievable if they just stay on their current roadmap.
And the $50 target.
That's the home run scenario. That's pricing in a successful on-time deployment of the 100-plus qubit system and that immediate commercial ramp-up we talked about.
What are the momentum indicators telling us right now?
There's definitely technical interest building. We're watching for a potential golden cross formation.
And for our listeners, that's when the short-term trend line crosses above the long-term one.
Exactly. It's a major technical signal that buying momentum is starting to build.
What about the options market? Is retail interested?
Very. The options activity shows a lot of retail sensitivity, especially around the $27 strike call.
So bullish bets.
Bullish bets that the price moves higher relatively quickly. And you have to mention the short interest. It's high across the whole peer group.
Which sets up a potential short squeeze scenario.
It's a textbook setup. If a big catalyst hits, that could dramatically accelerate any upward move.
So if we take the market's temperature today, the immediate mood is a bit mixed, maybe leaning bearish because of the price dip.
Right.
But that's being counterbalanced by that massive balance sheet. That $600 million cushion is what's keeping institutional confidence high, despite the volatility.
It's the ultimate tension in this stock. Short-term jitters versus long-term financial stability.
Okay, let's focus on that long term. What are the catalysts that could actually spark a rally toward those higher targets?
Well, the speculative chatter, it really boils down to two main things. First is hitting those quantum AI hybrid milestones. Proving that their system, tied to NVIDIA, gives a real measurable advantage over just classical AI. That would be huge. And second is, of course, the big one, the official, verifiable deployment of the 100-plus qubit system by the end of 2025.
Those are the internal milestones. Any external macro factors that could help?
Absolutely. A broad sector rotation if the market really starts moving into high-growth, high-risk tech.
Which could be driven by expectations of rate cuts.
Exactly. That kind of environment benefits a company like Rigetti that's focused on these futuristic hybrid solutions.
All right, let's flip the coin one last time. We've established the financial runway is long, but the technology is incredibly risky. What is the definitive bear case?
It's one thing, primarily, execution risk. It always is. This roadmap is aggressive. And this isn't just writing code. This is brutally complex physics and engineering.
So any delay is a major problem.
Any significant delay in hitting those equipment milestones is the #1 threat. And remember, their competitors are racing just as hard. The thin trading liquidity just makes that risk worse.
And that execution risk creates valuation risk.
It does. You have modest revenues today being measured against a valuation that's pricing in years of success. That gap has to be filled by execution. If that 100 qubit target slips into, say, 2026 or 2027,
Valuation gets questioned immediately.
immediately. And you can't forget the competitive pressure from IonQ and others and the background risk of dilution if they burn through that cash faster than planned.
But the safety net against all of those risks comes back to one thing.
The liquidity. That $600 million cash runway is the biggest mitigating factor here.
It lets them absorb setbacks.
It lets them absorb setbacks, it lets them withstand market volatility, and it gives them time to just focus on hitting their goals without the immediate threat of going bankrupt.
So let's try to summarize this for the listener. Rigetti's full-stack approach, combined with its huge cash reserves, seems to position it really well for that 2026 inflection point.
An inflection point driven by that 100-plus qubit target and the progress in hybrid AI.
So the recent holiday dip near 2255 could be seen as a potential entry point for investors with a long-term view and a stomach for volatility.
Emphatically a multi-year hold. You're not investing in next quarter's earnings. You're investing in a potential paradigm shift in computing.
And the next major checkpoint is that Q3 2025 earnings report.
Expected in early March 2026. That's the next big test of their commercial viability.
A final thought then, a provocative one for you to consider. How quickly will commercial enterprise adoption of these cloud quantum subscriptions actually accelerate once the 100-plus qubit systems are fully operational?
And what does that acceleration really mean for their revenue trajectory? That's the billion-dollar question you have to ask yourself. If you enjoyed this analysis, please consider subscribing to the podcast.